So I'm old enough to remember, literally a few weeks ago, when Keir Starmer gave the clearest indication yet that taxes were likely to rise in the next budget, currently due at the end of October. But the truth is, the closer we get, the more information comes out. So in this video, we're going to go through an article in the Times. The article is called "The 5 Tax Loopholes Rachel Reeves is Likely to Slam Shut." These are not necessarily tax rate increases, but they're changes to some of the exemptions and the quirks that exist in the tax system at the moment. But given we heard endlessly on the campaign trail that Labour would not raise taxes on working people, especially committing to not increasing the big 4 taxes: income, national insurance, VAT and corporation. And as you can see from this diagram, that puts about 80% of the total annual tax takers completely off the table for them. So this basically means they're going to have to resort to finding odds and sods, bits and pieces from all over the place in this remaining group here. The first is the capital gains tax uplift rule. Just let's be clear here. Capital gains tax is paid on the profits made from the sale of a property, business or shares that are above your tax-free allowance of £6,000. And notably, there are a couple of exceptions here. Your primary residence is the most obvious example, and a car that you might have. And the article points out that the rate of capital gains tax that you pay largely depends on what tax band you fall into, as well as what you're selling. So basic rate taxpayers will pay 10% capital gains tax on most gains, but 18% in the case of property. Higher and additional rate taxpayers will pay 20% on capital gains but 24% on property gains. And the truth is, there's widespread speculation that Rachel Reeves could increase some of these rates to match them with income tax, which would mean a 45% rate for additional ratepayers. And this gets to the idea that people who own assets and derive income from those assets will generally pay a much lower tax rate than those who have to go out and earn a salary. In fact, if you compare the rates, you can start to see what I mean. The capital gains tax rate is about half what it is for income. But what might also be on the chopping block is the uplift rule. Here's the explanation from the article that I think puts it quite nicely. Say a parent bought a £100,000 house which was worth £500,000 when they died 10 years later. A child inheriting that property and selling it 5 years later for £600,000 would only pay capital gains tax on the £100,000 difference, not the £500,000 gain since the parent bought it. And if Reeves removes the uplift rule, the child would pay the capital gains tax on the £500,000 gain, which, if they were a high rate taxpayer, would increase their capital gains tax bill from £24,000 to £120,000. This means that the tax is payable on the original purchase price of the asset. In the US, they call this the stepped up rule. And there was this study from the University of Warwick that estimated that abolishing the relief could raise about £1.6 billion a year. Haven't you heard? There's a £22 billion sized black hole to fill. Inheritance tax on pensions. This is something that we've discussed in other videos on the channel, but the main takeaway here is that pensions at the moment do not form part of your estate, and so they are categorically one of the best ways to build generational wealth in a super tax efficient way. And the article says inheritance tax is typically levied at a rate of 40% on the value of an estate above the nil rate allowance of £325,000. £500,000 if the main home is left to a direct descendant and the estate is worth less than £2 million. Anything left to a spouse or civil partner is completely exempt from the tax. This quirk has been in place since 2015 thanks to the pension reforms made under the Conservative Chancellor George Osborne. Changing the rules could raise an additional £2 billion a year, according to estimates by the IFS. But I think there's a really important point that we should mention right off the bat, and that is making changes to pensions, especially retrospective changes no less, is about as likely to be as welcome as a turd in a hot tub. And it also doesn't seem fair. People could have made perfectly sensible and reasonable financial decisions, and they could now be caught out by this change with a massive tax bill. But I also think it's worth pointing out that only around 3 or 4% of UK households are even liable for inheritance tax. When you look at the price of the average house in the UK compared to the allowance, and that pensions are excluded, it's pretty to see how it's a tax that most people just don't need to worry about. But it's worth noting that including pensions in someone's estate and therefore making it liable for inheritance tax could have a bunch of unintended consequences. One of the things I've noticed is that pensions are easily one of the most misunderstood parts of personal finance in the UK. So adding this fuel to that burning fire might not be a great idea. And worst of all, it might also discourage people from actually investing their pension, which would just be an absolute disaster. Tax relief on AIM stocks. But unlike the main market, the FTSE, which is more regulated and typically caters to larger and much more established companies, AIM offers a much more flexible framework for these smaller firms. And from a tax perspective, investing in AIM stocks has got some pretty good tax benefits. These investments are free from inheritance tax as long as you've held them for at least 2 years. And to be honest, I think this is a pretty fucking weird one. Why would an AIM stock be exempt from tax. And the article points this out too. The piece says this is a pretty heavy loophole and it doesn't seem particularly rational or fair that this type of investment is exempt from inheritance tax whilst others aren't, says Dan Needle, a tax lawyer and founder of the consultancy Tax Policy Associates. Needle estimates that axing the relief would raise between £1 and £1.5 billion per year. I think it's worth pointing out that inheritance tax is one of the most complicated and loophole-ridden taxes imaginable. And so it feels as though there's a more sensible set of reforms that could be applied here. And that's basically how this guy inherited a £9 billion fortune and only paid £9 million in inheritance tax. Truly phenomenal stuff. I'd also point out that I've worked in finance for over a decade and I literally don't know a single person who has invested in an AIM stock. GameStop, however, a different story. Tax-free ISAs. Now, ISAs are one of the most important accounts when it comes to building wealth in the UK. We've assigned on this channel the ISA the God tier status of wealth building. The main tax benefit of the ISA is any money up to £20,000 a year is exempt from income and capital gains tax, and there is no upper threshold on the amount that you can hold in an ISA. But there's more to it and some nuances around it, but that's the main thrust of the ISA. But as the piece points out, this relief costs the UK government about £4.9 billion in 2022 to 2023 and is expected to cost around £6.7 billion in tax year 23 to 24. The Times article points out capping relief at £100,000 on money held in these accounts could raise about £5 billion this tax year. But this is the case we discussed in another video. Until we know what the tax is going to be, how it's going to be applied, or what the tax rate is going to be, it seems difficult to determine what overall effect this would have. The Times article also points out any tax raid would be unlikely to be backdated. People have saved for years into their ISA on the promise of this particular tax treatment, and many would see it as a hugely unfair change to this. I don't think the government would do that. And whilst we're here, we should also mention that there was a proposal for the British ISA, an additional £5,000 per year, provided that the investments were made into British companies, but it was a poorly thought out idea. And low-key, I have junior ISAs for my kids to help them pay for university and a deposit for a house, so I will be livid if they start messing around with ISAs. That dog just ain't gonna run. We should also point out that a vanishingly small number of people even have a stocks and shares ISA, a travesty in and of itself, and an even smaller percentage of those maximise their ISA allowance every year. So adding another £5,000, just increase the threshold. Why does it have to be British companies, and how do you define British companies? Business asset disposal relief. So there was this thing that used to be called entrepreneurs tax relief and is now known as business asset disposal relief, which was introduced in the UK in 2008, basically as a tax incentive to encourage entrepreneurship and reward individuals for building and growing successful businesses. It was designed to reduce the capital gains tax bill down to a heroic 10%, but several changes have been made over the years. They've changed the name, really starting with the important stuff. In 2020, Entrepreneurs Tax Relief was renamed to the Asset Disposal Relief, but most importantly, the lifetime reduction was changed as well. In 2020, qualifying gains were significantly reduced from 10 million down to 1 million. So you used to be able to sell your business for up to £10 million and only pay 10% in tax. But this has now been reduced to £1 million. So they've already had a bit of a go with this one. And according to HMRC, the relief costs the government an estimated £1.5 billion in tax year 23 to 24. And I think it's worth saying this is something that only benefits higher and additional rate taxpayers who would pay capital gains tax at 20%. Basic rate taxpayers already pay capital gains tax at 10% on profits made from sales. But as the article points out, critics have argued that there is little evidence that the release has boosted entrepreneurial activity. In 2018, the Resolution Foundation, a think tank, dubbed it as Britain's worst tax break, saying that it was too expensive and ineffective. And I think it's also worth noting there's plenty of other analysis out there that says entrepreneurship was not necessarily incentivised too much and that the amount of effect it actually had is very much up for debate. So the truth is these 5 changes are just a taster, a real palate cleanser of what might be on the way in October. For the full list of 20 possible tax rises, make sure you watch this video here, where we go into a lot more detail on all 20 possible tax rises. But we should say, at this point, all of this is speculation, but these things are definitely being floated around. Thanks very much for watching. If you've liked this, please like and subscribe. It doesn't cost you a penny, and if you think I'm talking absolute horseshit, you could just unsubscribe later. Thanks very much for watching.